2021. September 2021. So open September 2021. Which page is that if you are there? Page 30. So that is page 30. September 2021. It's page number 30. The one for Uruma, something, eh? So September 2021. Question number 3, Roman 2. So let's read the question. So Susan, you're being told the paper for tax has been forwarded to the group. So Uruma Limited, a public limited company, has a portfolio of investments, including various subsidiaries, and also undertakes various projects, varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statements relating to the deferred tax provision for the year ended 31st March 2021. So this one as group aspects, and actually the new syllabus, if you check the new syllabus, they are saying deferred tax with group aspects, so it will be good for us. But now reading all these things, it's a waste of time. What do they want? Check the required so that we can work smart. Determine the deferred tax asset or liability for Uruma Group as of this in conformity. So to determine deferred tax definitely will require temporary differences. So let's lay down our format for temporary so that as we read, we can be making postings. So right there, Uruma Group, deferred tax computation, as at 31st March 2021. 1st March 2021. So have that. So let's have assets and liabilities. Assets and liabilities. They are carrying amounts. They are tax base. Then temporary differences. So shilling seems to be millions. Then maybe your settings are not very good. Check out. So have that one ready. So as we read, we just post. As we read, we can make the postings. So I hope everyone is ready. It says, number one, so additional information number one. Additional information number one. Huruma Limited acquired controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. Okay. The fair value of the assets and liabilities acquired were considered to be equal to their carrying amounts, with the exemption of freehold property, which had a fair value of 256 million and a tax base of 248. The directors of Huruma Limited have no intention of selling the property. So you write there, PPE, property, plant, and equipment. So that means page 30, we are page 30. Why are you not saying? I hope. Okay. So PPE, they are saying the fair value was 256 and a tax base of 246. So where we have the fair value and we are not given the book value, then fair value becomes the book what? The book value. Actually, that is the correct value of the asset. So the carrying amount will be 256, and the tax base, they have said is how much? 248. So the difference is the temporary differences. Where there is fair value and Thomas alikutumia pepa. Thomas, wewe ni mbaya eh? Thomas alimtumia pepa ya tax. Nilisikia deferred tax akatumia Susan pepa ya taxation. So Susan anatafuta swali kila mahali kwa hiyo tax. Thomas, why are you confusing Susan? So that is okay. So temporary differences comes to how much? 8. Number two, nasonga pole pole. Number 2, during the year, Huruma Limited sold goods at a selling price of 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in the inventories of Wingu Limited as at 31st March 2021. So there we want to talk of inventory. We want to talk of inventory. So they sold at a price of how much? Okay. They sold at a price of 48. Wingu Limited made a profit of this on the transaction. 40% of these goods were still held. 40% were still held. So how much is the book value of the remaining stock? The remaining stock, yes, that is okay. Can you tell me what is the book value of the remaining, the inventory which we should consider as remaining? Because you are good in group accounting, Can someone give me a figure? In the consolidation, what value should we take as of the remaining stock? Somebody? The way we normally do consolidation, what should be the inventory on consolidation? Sure. How much? I want the answer, the exact answer. Hata kuna kufikiria iko straight. Make sure you deal with the UPI. UPI must be eliminated for group. 16 was profit. James, 12.8, Martha, 40% of 48 minus 16. That is the same with what is saying. So it is 12.8, what you are saying. You know, 12.8. Yes, because in group accounting, we must subtract what? The UPI. So number one, tunasemanga kuna mambo ya profit within group members. So the goods have been sold at how much? At 48. So the 48, first of all, subtract what? Profit. Stock should not be recorded profit inclusive. So 1048 minus 16. So that one gives you how much? 32. Then this 32, they are saying that what percentage remain? 40% of these goods were still held. It means they sold the rest. So 40% of 32 is what is remaining. That is 12.8. So give us here 12.8. Tax base. How will we calculate the tax base? How will we calculate the tax base? Or tax base will be how much? Taxman will assess how much? Yeah. 48. Tax base will be, or what procedure will make us siwarakishi pole pole to just check. Let's just take time to check. How will we get the tax base? %. Some people are saying they think it's supposed to be 48. Now I'm saying 30% of 48. 30% imetoka wapi? Is that not your what? I did not 6. Yeah. Jonathan, 40% of sales. 32. What should it be? It go to straight. 32. Okay. Hey, you know, for tax purposes, okay, let me for tax purposes, those people don't want you to subtract the unrealized what? profit. Okay, I really don't want you to subtract unrealized profit. So the way I think somebody said it, you will check the 48, you know, taxman will go back because you know some people will want to actually less group accounting, we subtract. If you sold to the other person at a profit, for tax purposes, we will not subtract the unrealized what? Profit. So it will be 48, fine, but what percentage remained? 40 what? 40%. So we will check on the whole amount. So those people saying 48, you must work with what is remaining. So it will be 19 point what? 19.2. For tax purposes, no subtraction of the unrealized profits. You know, we have to understand. So you will get a profit. You might know in your books, fine, subtract the unrealized profit. For taxation, no subtraction. So how much is that? 6.4. And that is negative. Inventory is tax on sales. Line of thought is, for taxation, we don't subtract the unrealized profit. The intention might be you want to understate tax. So we will work with the whole amount, but we multiply with what remained in the stock. Very good. Let's go to number 3. Let's go to number 3. Number 3, Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purposes. Okay. These investments are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss. These gains or losses are taxed when investments are sold. Currently, the investments have a market value of 412 and accumulated and realized gains are 64 million. So investments, what should be the carrying amount? It is there. The carrying amount should be how much? 412, correct. So 412, that's then what should be the tax base? Just play around with the 64. Do we add the 64 or we subtract? We less. So no, because they are saying, what are they saying? Unaccumulated unrealized what? Gains. So unrealized gains, if it was a loss, we top up. But the unrealized gains, even actually they were saying, what were they saying somewhere? These gains or losses are taxed when the investments are done what? Sold. So you can even argue from that point, the investment has not been sold. So it means the unrealized gains will not be done what? Taxed. So you take the 412, then you subtract the 412, you subtract the unrealized gains of 64, and we report how much? 340. Okay, so we'll assess that 44 for tax purposes. And you are likely to get deferred tax of this nature, group aspect. That's what they have said in the new syllabus, but not overwriting what we were doing previously. Number 4, Huruma Limited loan notes had a carrying amount of 168 after an allowance of 32, based on 12 months expected credit losses. Tax relief is only available when the specific loan is written off. So right there, loan assets. Loan assets. What is the carrying amount? 168 after an allowance. So gross up the allowance. When you gross up the allowance, what do you get? 200. So we have there negative 32. Number five, Huruma Limited has unrelieved trading losses of 20 million. They have unrelieved trading losses of 20 million. These unused tax losses, arose from a one-off restructuring exercise carried out during the financial year. And it is highly expected that taxable profits will be available in the future. So we have unused tax losses, which normally gives us tax credit. So you come here and say, unused tax losses, unused tax losses, unused tax losses, unused tax losses. Repeat that sentence again. Read it once more. And you tell me the carrying amount from what you can see. What should be the book value according to what you can see? There. As unrelieved tax losses of 20, these unused tax losses arose from a one-off restructuring exercise carried out during the financial year. And it is really, oh, somebody, Edmond, you are asking what is loan asset? Loan asset are just, if you go to the serious definition, Wanakuambia loan asset is a loan participation originated by the borrower, but just know that loan asset is an asset. So, Joyce, 0, as they were unused. James, no carrying amount. They are correct, by the way. There is no carrying amount. There's no book value. You know, unused tax losses. You know, tax loss is always meant to, is a credit to Nelem. Yes. So if they are unused tax losses, which were not utilized, then the book value is 0. There is no carrying amount in that effect. But the 20 which they have, the taxman will have to assess that one for taxation purposes. So that at the end of the day, we still have unused tax credit of how much? 20. You know, if you say 20-0, you are going to tax it, but it should be a credit on our side. So if they were used, then the carrying amount is 0. But the tax base will still check 20 for tax purposes so that we can have a credit at that side. That is all. So you can add, then we get deferred tax. Deferred tax, 30% of what you get. 30% of what you get. So what are you getting in aggregate? 13.6. So 13.6. So the tax there will be 13.6 by 30. You get 4.08. What did they want? Determine the deferred tax asset or liability. So we have a deferred tax liability of 4.08. Full stop. Somebody is asking 8 marks, you mean? Yes, it is 8. But it's a dangerous question. So if you get Adam, you are ni mingi. Tuende kwa hiyo swali lingine. September 2015. Look for it, then you tell us which page. Haya, kama ni mingi sana, wewe utaangukia. But here, I don't think, you know, most of the mark here. One, but they will still mark here, but I know how they can mark it. It can be 1, 2, inventory. Inventory was not meant for everyone. So it is 1, 1, 2, 3. Investment was not that bad. Loan asset, not that bad. But this one is bad. So it is 1, 2, 3, 4, 5, 6, 7. Then tax. The deferred tax itself makes it 8. They normally plan it. They can plan it in that order. Because this one had a lot of thinking. This one also had a lot of thinking. Then the answer. So this one can be allocated 2 ticks. Let's go to September 2015. Which page? Come on, vizuri. 117. 117. Page 117. Let's meet at page 117. I'm already there. That is September 2015, question 3B. September 2015, question 3B. Wengine wako nayo kwa page 113. Whichever makes you happy. So I hope everyone is there. So allow me to read. So Fistic Limited, a newly listed company, has provided this question. One of these fine days, so Fistic Limited, a newly listed company, has provided the following information with regards to computation of its tax expense for the year ended 31st May 2014. So we have, so this is 2014 computation. We have accounting profits. We have depreciation. We have donations. We have amortization of software. Then they got taxable profits. You know, oh, ama swali ni mbaya. What were tax? Steve is asking, are you supposed to tax donations? That is what is making Steve unhappy here. Huh? What were tax? Donation, how do you deal with donations for tax purposes? The answer is very simple. Yeah, exactly, that is the answer, Thomas. It depends. There are some donations which are allowed and some are not allowed. For example, if you donate to Section 5 students, that is not allowed. But if you donate to charitable organizations, yes, that one is allowed. Allowed means you subtract for tax purposes. So this one has been disallowed. You see, they have added back. Yeah, you know, they started with accounting profit. Then the ones which were not allowed for tax purposes have been added back. So people are giving serious answers. So add back depreciation, add back donations, add back amortization. They have disallowed them for tax. So taxable profit is 52,300. Then there is capital allowance of 75. Tax expense in 2014 was at 25%. Why do you think they gave them 25% and not 30? Right? Yeah, the company was new. Mostly, there are some entities like EPZ, when they are new, you can tax relief for some period. So we are assuming they had 25% because the company was newly listed or formed, whichever. The company has not yet determined tax expense for the year 2015. So I know that is what maybe they want us to determine. Additional information, number one, accounting profit for the year ended 31st May 2015 was 55,200, while donations amounted to 600. Now those are for 2015. An extract of non-current assets movement schedule for the year 2015 was as follows. So cost 1st January 2014, those are the values of the plant. 1st June. Additions during the year, there were no additions. Accumulated depreciations, as you can see, tax written down value. That tax written down value, just know that is the tax base. That is what you need to know. Tax written down value is the tax base. Plant is depreciated at 20% per annum using the straight line method, while wear and tear allowance on plant is provided at 25% on reducing balance basis. Software development commenced in the year 2011 and was completed in the immediate subsequent year. The company capitalized development costs, which amounted to 9 million, and amortization commenced on 1st June 2012 using the sum of digits method over the estimated useful life of 5 years. Software development costs are allowed in full for tax purposes in the year in which they are incurred. Donations made by the company were not tax allowable. Corporate tax rate applicable on the company's earnings for the year 2015 is now at what percentage? 30%. And the company is expected to continue generating taxable profits in the foreseeable future. Required current tax to be charged in the income statement for 2015. Deferred tax liability to be reflected in the statement of financial position. Then deferred tax liability account for 2015. That one is giving us roughly how many marks? 14. No. Yes, 14. So let's start. They want us to determine the first one, current tax to be charged in the income statement for 2015. So right there, sophistic. Sophistic Limited. Taxable profits. Computation. Let's get taxable. So from taxable, we will get current tax. Because how do you get current tax? You take the taxable times the tax what? The tax rate. So let's get taxable profits. Computation. For the year ended. For the year ended 31st May 2015. 31st May 2015. So 31st May 2015. Shillings are in what? Shillings are in thousands. Let's operate two columns. So what we want to do, you know, not everybody is doing tax. Even in this class, not everyone is doing tax. Maybe only 2 or 3 people. So examiner was trying to be fair to everyone by giving us the procedure they followed for 2014. 2014 when you walipanga. So they were giving us how to, they are trying to show us how current tax is computed, or in which case they computed the current tax based on the taxable profit. So what I want us to do, and what you should do, that 2014 should be a guideline to us in 2015. And by the way, I want us to follow that format of theirs, but now everything we bring in relation to 2015, yes. So let's start from top. Accounting profits, we start with the accounting profits. Accounting profit, were we given the accounting profit 2015? Don't pick 2014 again. Accounting profits, how much for 2015? Which note? Note number 1. Accounting profit for 2015 was 55 to 100. So we are trying to copy that one, but in relation to 2015. Their next item is which one? Depreciation. So you add back depreciation. Add back depreciation. So depreciation we capture for 2015. In which note did they mention depreciation? Note 3. Plant is depreciated at 20% per annum. Using which method? Straight line. Straight line means you charge on the initial cost. Straight line you charge on cost. So what was the cost of the plant? Are you seeing the 32? Yes. So depreciation will be 32 by what percentage? 20%. So what is 20% of 32? 64. 6,400. We can bring it here. Then after that, after depreciation, there is what? Donations. Were we given donations for 2015?
Yes.
Note number 1. Check note 1. That while donations amounted to how much? Donations amounted to 600. Then after that, amortization. Amortization. So you will bring amortization for 2015. So amortization was mentioned in which note? 4. Software development commenced in 2011. How many years ago? Are you sure? 2011, 2012, 13, 14, 15, yes. 4 years ago, It commenced 4 years ago and was completed in the immediate subsequent year. Immediate subsequent year is 2012. The company capitalized the costs, which amounted to 9, and amortization commenced in 2012. So they started amortizing it in 2012, 3 years ago. Okay. Using which method? Sum of digits method. Sum of digits method. So sum of digits is a very funny method. Sum of digits. To work with sum of digits, check the useful life. What was the useful life of that software? Using the sum of digits over the estimated useful life of 5 years. So sum of digits, you add year 1 plus year 2 plus year 3 plus year 4 plus year 5. That is the sum of digits. Hiyo ilikuwa inafanywa kwa MA. Watu walifanya advance MA wanajua hiyo kabisa. Sum of digits, that is how it operates. 1 plus 2 wanachikia calculator. How much? 6, 15. Yes, so that is the sum of digits. Then, since the amortization started, we are in which year? So we are in year 3. So we are in year 3. So you come and say amortization for 2015. Amortization 2015 is year 3 out of the total. Out of the total, which is 15 times what value? What was the cost of the software? 9. So how much is that? 3/5 by 9. 1800. 1800. So bring here 18. And by the way, sum of digits is very funny. You need to be very keen. 2014, let's check for 2014. I know you might end up not getting it. 2014 was which year? Since the amortization started, commenced. It was year 2. Can you work and get there? See what we prepare for you. They have given us amortization of software as 24. Can you work with that if you will get 24? I know you will not get 24. Are you getting 24? Huh? You are getting 1200. Yes, because you are using it in the wrong way. That is not how it is applied. Sum of digits operates this way. Here is a coincidence that it was year 3 and year 3 is 3. It works on the assumption, which is the truth, that the assets loses at the higher value in the first what? In the first years. So you allocate more as you reduce. So in year 1, if I was to go to year 1, 2, 3, 4, 5, year 1 you allocate 5 over what? 15. Then year 2 you allocate 4 over 15. So year 3 where we were, it was just a coincidence that year 3 is also what? 3. Then here you allocate 2, here you allocate 1. If you work with 4, will you get the answer there? 4 over 15 times the 9. Yes, so that is how you operate the sum of digits. So they can bring that question, but now they change it to be maybe year 4. So if it is year 4, don't take 4 over 15 if you are using sum of digits. If it is year 4, you will go for 2. It goes at it reduces. Yeah, so that is how we operate the sum of digits method. Now, you've understood and you've understood very well. So if it comes, don't say, oh, you are not consulted. So we are done with the add backs. So can you add this total? 64 plus 6 is 7,000. 7,000 plus 18 is 8 what? Is 88? Yes, then capital allowance. So less wear and tear. Did they say wear and tear, or I'm just creating my own thing? Yes, wear and tear allowance. So you give us wear and tear allowance. Wear and tear allowance is mentioned in note number 1. So check note 1. No, sorry, note 3. Plant is depreciated at 20 on straight line, that is fine. While wear and tear allowance on plant is provided at what percentage? 25% on reducing balance. So wear and tear is not based on the cost or what? It is based on the tax written down what? Value. You see they are saying on reducing. Reducing, come in depreciation, reducing balance, we normally charge on net book what? Value. Sure. Reducing balance, we charge on net book value. But for tax, you know where and tear is for tax purposes. We charge on the written down what? Value. So charge that on the written down value. Written down value was how much? Our written down value is 18,500. tax written down value on 1st June 2014. 1st June 2014 is the beginning of this year. So you charge on the tax written down value for tax purposes. That one will give you 46.25. Therefore, taxable profits will be 88 minus the answer, you get 41.75. 41.75. Therefore, current tax liability will be 2015 was 30 or 41.75. That is 12. It is really 41. No. Oh, we omitted the 55. Yes, that is too small. 55 200 plus 88 minus 46 40 46 35. You get 59 375. Sure. 59 375 times 30. 17 812.5. That is the current tax. Who has a question? We are done with Roman 1 of that question. Adan, why are you now not saying how many marks? 4 marks. This now what's for? So if they are marking that one at any 4 correct entries, will you just get 0 even if you don't get the correct answer? Will you come out like that? All right, let's go to required Roman 2. Required Roman 2. It was password and not other. Okay. Deferred tax liability to be reflected in the statement of financial position. So they want deferred tax liability. Ukisikia tu deferred tax, chora ile schedule yetu. Assets, here there is no liability. We only have assets. So assets carrying amount tax-based temporary. Let's have that arrangement. Let's have that arrangement. So Roman 2 of the question, you say Sophistic Limited deferred tax computation as at the what as at 31st May 2014. You want it for 2014. So you give me here assets. You give us the carrying amounts. You give us the tax base. Then we will have the temporary differences. So assets, we only have 2 of them. We have plant and we have which one? Software. We only have those 2. So land carrying amount. Carrying amount is the net book value, 2014. So I don't think if it's going to be very serious, it's easy. 2014, you can see the cost was how much? Cost is 32. Accumulated 2014, 19,200. So the carrying amount is the cost minus the accumulated depreciation, 2014. So you take this one here, 32 minus 19,200. That one becomes the carrying amount. You get 12,800. Good. Then we go to tax base. Tax base is there is no reasoning at all. Tax base is the written down value in 2014. Tax base is the written down value, which is how much? 18,500. 18,500. So you take this minus that. You get that one. I put a negative something. How much negative? 5,700. Taxable or deductible? Deductible. Deductible. All right, let's go to software. 2014. What was the cost of the software in 2014? It was 9, eh? It was 9. Then you subtract, you're supposed to subtract accumulated amortization, but they have just wakandika to accumulated depreciation, wakaleta huko. So we'll assume, but the correct name should be accumulated amortization. Anyway, they have given us how much? Are you seeing the 54? Yes, so 54 is the accumulated 2014 for the software. So 9 minus 54, 3,600. Then tax base. Tax base, I want you to read this note. There's a note somewhere where they are talking of a lot of stories. The last bit of note 4. I want you to check the last bit of note 4. The last bit of note 4, software development costs are allowed in full for tax purposes in the year in which they are incurred. When did they incur this development cost for the software? Kitambo 2011, eh? Sure, in the same note. So in 2011, the whole amount had been allowed for tax purposes. Therefore, the tax base is what? 0. They have said the whole amount was allowed. So what do you want to assess for tax? Nothing. So give us here 36. Therefore, temporary differences, and mostly you need to check. Don't rush. For most intangible assets, you will always find that the whole amount is allowed for tax purposes in the year in which it is incurred. So coming on a book value, so we need to check it for tax. So 57, that one. Okay. It's 100, but negative. Deductible. Deductible. Therefore, deferred tax what? Liability or asset? Asset. Negative will lead to an asset. Deferred tax asset 2014 will be 21 times the tax rate, which is 25%. In 2014, they were being charged 25% for taxation. So you multiply by 25. 525. So we have a deferred tax asset of 525. Who has a question? If no question, we go to the next one. The deferred tax liability account for 2015. So 2015, there's no way you will come up with deferred tax account 2015 if you have not determined the deferred tax for 2015. So we have an obligation to determine deferred tax for 2015, then we come up with an account. In which case, this one for 2014 will be the balance brought down in 2015. Then the one we calculate for 2015 is the carried down. Then we get the difference which goes to P&L. So let's get 2015. So right there, we can make it official by writing everything. Sophistic Limited, deferred tax computation, 2015. So that one they will not mark. We are just doing it as a working to get the deferred tax. But there is no way you will arrive there if you have not passed through this channel. So have your assets, carrying amount, tax base, temporary differences. So the same assets are the ones which are still there. So we have plant and we have the software. We have plant and we have the software. So carrying amount for plant, we can take so many routes, 2 routes. I don't know which one you want. You can take, by 2014, the remaining book value was how much? 12.8. So you can take this 12.8 minus depreciation for 2015. So you take this minus depreciation was 64. Or if you want to go the long route, start with initial cost, this minus accumulated depreciation up to 2014 minus 64. Which one is better? Which one do you want? This one. I go for the book value last year, then minus depreciation for this year. So you just take 12.8 because you get the same answer, 64. So 64 is the depreciation for this year, 2015. So you just take the value by last year, subtract the depreciation, then you get that. How much is that? 64 baht. Okay. All right. Then tax base. Tax base, you can do the same thing. Tax base by last year, written down value by last year was 18.5. Then this year, wear and tear was how much? Wear and tear is 46.25. So you take this minus the 46.25 as you punguza. So this was the tax written down value minus wear and tear, the allowance. So you continue reducing it. It will be how much? And please show where you are getting your figures so that you don't look for it. 13,875. That is the tax written down value for tax purposes. So that temporary will be how much? 74.75. Software the same. We can do the same. You take 36 minus amortization in 2015. 2015 amortization was how much? 18. So you take 36 for last year minus 18. And if you have years to go, you just do that. You will be taking 64 minus depreciation for next year. So 36 minus 18 comes to 18. This one was allowed for tax purposes in full long time ago. So there is no tax base. So this is 18. So how much is the net temporary differences? Okay. 57. Huh? 57. 56.75, also negative. Therefore, deferred tax asset for 2015, therefore, deferred tax asset 2015 will be 56.75, but 2015 they were charging tax at what rate? 30. So 2015 you charge at 30%. How much do you get? Wow. 1702.5, which is an asset. So the examiner wanted deferred tax account. So come up with deferred tax account. Deferred tax account. Deferred tax account. So deferred tax account for which year? 2015. 2015 there. So you start with balance brought down. Balance brought down is the tax for 2014. 2014, apparently, it was a deferred tax what? Asset. So deferred tax asset will be brought down on the debit side. So the brought down from 2014 will be on that side because it was an asset. It was an asset, so it will be brought down on the debit side. Then 2015 closing, 1702.5 is also an asset, so it means it will close this side. So 1702.5. If there were liabilities, then you go the opposite. Therefore, the balancing figure is what goes to profit and loss account. The balancing figure. So get the balancing figure there, then that is all. So that is it. That is it. With those questions we have done on deferred tax, just practice them. 1177.5. Fine. Practice with all those questions. If they will bring, they are going to bring one of. You have to see at exact. They'll bring one which resembles one of them. Personally, you think 2015 is a liability. What makes you think it's a liability? What makes you think it's a liability before we close that chapter so that we can help you from that point? Why do you think it's a liability and not asset? Negative. So online, Pascal is saying if it is negative, it should be. Now, positive. When 2014 is a liability, and appear negative. If you negative tax is a liability. Steve, are you a tax man? But from the tax, you know. First of all, negative tax is an asset. It's not. Other you can reason from the basics. VAT ukipata negative, you pay. Negative net VAT. She's a credit. which is more or less an asset on your side. Yes, so people have spoken. Yes. For 2015. The way he has framed that, they calculate deferred tax liability. So negative liability is an asset. Very possible. What are this level of getting negative? Can we also get differences between permanent differences and temporary differences? Can we also get differences? Not coming out very clear, Janet. We be getting differences in terms of nodes or in terms of computation. Try to be clear. So allow me to end that topic at that stage. Kazi kwako. Ukisema upate deferred tax liability, si lazima upate positive. So I want us to start a new topic, but I'm giving you 2-3 minutes break because online kuna wenye waliamka. Watoto wajakunywa breakfast, lazima wapewe pesa waende breakfast. So you plan them haraka 2-3 minutes, then we start a new topic here. So you can refresh up 2-3 minutes, then we start. We are coming back for IFRS 8. Refresh up kidogo. Organize one too. He has come to tell me that nobody needs a break. Differences between permanent and temporary differences. I gave you in the notes. Sure. It was a question in 2020. I did. So Janet, check the notes. I gave you in the notes, so refer to the notes. Thank you. So IFRS 8 is on operating segments. So right there, operating segments. I don't know, we really waited for this one. That means last semester. BPM, operating segments. Operating segments. What is a segment? A section. A department. So all that section, department, and all that. So like here, in the college, this is section 5. There is 4, 3, 6. So this section 3, 4, 5, and 6, these ones are segments. Then at the end of the day, the college will report, they say that we have reported a profit, though this college is not in profit making. Schools classified under profit making? So if there is surplus or profit, we need to know how much came from this section, this one, this one, this one, how much is their revenue, their expenses, which assets are there. So when you are trying to report on sections, then what you are doing what is called segmental reporting. So right there and say an operating segment, we have one page to write. An operating segment is a component. An operating segment is a component of an entity. Is a component of an entity that engages in a business, in business activities. I repeat, an operating segment is a component of an entity that engages in business activities from which it may earn revenue. It may earn revenue and incur expenses. Revenue and incur expenses. Incur expenses, open a bracket, including revenue and expenses, related to transactions, with other segments within the same entity. Other segments within the same entity. Close the bracket, full stop. Full stop. Another hyphen. A segment should be a component. A segment should be a component of a business. Should be a component of a business. A component of a business whose operating results are reviewed on a regular basis. Full stop. Subtopic, reportable segments. And I have to tell you very early, this is one of the key areas we are checking for this setting, but it can miss. Reportable segments, you say, so subtopic is reportable segments. Then you say, IFRS 8 requires that an entity do these things of friendship work. Do they work? Really? Is there a genuine friend? I don't think. Because, like you, me, I don't think. There's a guy who was my close friend, very close. After school, we started hustling together, and doing everything together. And even we started teaching together. And even we used to stay in the same house. You see, and even same house and even sleeping in the same bed as you struggle. Then now he left me in teaching. Then he was absorbed by CASNEM. So he worked somewhere called, I don't know, they call it cold room, where they pack exams. So even if I ask him, have you seen a file? It doesn't even pick my calls nowadays. Which integrity? It's exercising integrity. Assuming it is you, you cannot even tell me something. Can you? Even your close friend? We are dead. I'm the bad friend here. You see? I'm the bad friend. But so Mother has put it in the right way. You should understand people are only you have life for some reasons. And when the reason is gone, so that is life. Password is asking, was she a lady? No. So reportable segments, you say, IFRS 8 requires that an entity should only report on a segment, if it meets the following criteria. If it meets the following criteria. That is a frequently asked question. Number one, so when should you? So when you have so many segments, check at Safaricom. How many segments are there? Okoa is there. M-Pesa. Yes, there are so many. So you don't report on every segment within the entity. For you to report, number one, if it's reported revenue, both internal and external, both external and internal, forms at least 10%. That is the threshold. Forms at least 10% or more. 10% or more of the combined revenue. I repeat, Sharon, if it's reported revenue, both internal and external, forms at least 10%, or more of the combined revenue. Full stop. At least or more. Or at least is enough, by the way. We presume at least it means that is the minimum. Yes, so for you to report on a segment, take the entity as a whole. Rule 1, for you to report on them, at least their revenue should be at least 10% of the entire for the company. Number 2, if it's absolute measure, if it's absolute measure, it's absolute measure of profit stroke loss, is at least 10%, is at least 10%, at least 10%, at least 10% or more of the reported profits stock loss, of the reported profit stock loss. And finally, if it's absolute, what's the word absolute? If it's assets, are at least 10%, or more, at least 10% or more of the reporting segments. If its assets are at least 10% or more of the reporting segments, full stop. There are those three. So for you to report on a segment, the revenue, the assets, and the profit should be at least 10% of the total aggregate. So there is a disconnect there. Someone should ask me, what if the asset is 10%, but the profit and revenue does not meet the threshold? Then when I go to this other segment, the profit is meeting the threshold, revenue and assets are not meeting. Provided it meets either of the three, then you should report on that segment. Provided either of the three, at least one of the three, then you report on that segment. Down there, if a segment fails to meet, the 10% threshold, if a segment fails to meet the 10% threshold, comma, its operations should be aggregated. Its operations should be aggregated with those of other segments, in order to meet the threshold. Full stop. Another paragraph. If the external revenue of a reportable segment, I will send the notes, so don't worry. No, kuna watu early morning, na evening, na day. Kama kuna early morning? Early morning najua hizo kuja. Ako hapa online, but evening na day, so it will be shared. The Thomas will share for early morning. Noli will send the day. Then nani tatuma evening? Steve. Tatuma evening, so aya sawa. So if the external revenue of a reportable segment constitutes less than 75%, there's another cut, constitutes less than 75%, of the entity's revenue, comma, then additional operating segments should be identified. Additional operating segments should be identified. As a reportable segment, even if they fail to meet the 10% threshold, even if they fail to meet the 10% threshold on profit stock loss, full stop. But that one is quite ngumu. They are saying even if it is reportable, but the external does not meet 75% reporters of the reported external revenue, then we should not. We need to identify another one which meets at least 75 but fails even to meet the 10% threshold for internal purposes. But that one, advantages of segmental reporting. Advantages of segmental reporting. Advantages of segmental reporting. Number one, you say it provides a condensed ile kadogo. A condensed information to the users of financial statements, to the users of financial statements. Number two, that is okay. Number two, it promotes accountability and transparency to the management. Transparency and accountability to the management. Next, it is a requirement. It is a requirement. It is a requirement of IFRS 8. A requirement of IFRS 8. A requirement of IFRS 8. Sawa, Susan, that all listed companies should provide a segmental report. Should provide a segmental report. A segmental report at the end of each reporting period. At the end of each reporting period. At the end of each reporting period. Full stop. Those ones are enough. You can look for others. Limitations of segmental reporting. Limitations of segmental reporting. Limitations of segmental reporting. Limitations of the segmental reporting. Number one limitation, you say identification of primary segments, identification of primary segments, for reporting purposes may be subjective. Identification of primary segments for reporting purposes may be subjective. Ngumu, because unapewa 10%, unapata hii imefika 10, ukiangalia external revenue, I think 75. Yes. Next, it increases operational costs. Increases operational costs. Since segmental reports segmental reports are considered to be additional information, are considered to be additional information to the financial statements. Even those of us who are in audit, it's not a must you go up to the segmental, but if the client wants a segmental report, then you charge. It's a different engagement. Next, it may delay the AGM. It may delay the AGM since the shareholders may be interested on the segmental information. The shareholders may be interested in the segmental information. Ndio wajue which department wanakatuwork na wafanyi kazi. Full stop. Full stop. I repeat, it may delay the AGM since the shareholders may be interested. We've been interested in what? Segmental information. We've been interested in the segmental information. Mostly wanakanga hiyo, so that they pin down some people. Wenda kwa ofisi ya watu unapata watu wanaweka makeup peke yake na wanakula crepes. Ukienda wanakwambia go to 7th floor. So hizo ni 3rd floor. Ukienda 7, hata before uingie unaulizwa who has sent you here? Can you go back to 3rd? Kwenye umetoka. They don't want to work, but when people report profit, they are the same people who start at we need a salary increment. On what? So even for performance appraisal, segmental reporting is actually it can be one of the advantages of it is used by the management for performance appraisal in different departments. They normally use that to know which department is performing. So I need to give you the format for preparing a segmental report, but before that, let's tuchape swali lingine hapa which does not require the format, then I give you the format. That's all. So get out your past papers for September 2021. That question tulikuwa hapo. I don't know whether you are there. September 2021. I want us to do something there. In my page, I think it's page 30 or thereabout. Yes. September 2021. Question number 2B. September 2021. Question 2B. Question 2B. Sawa. Let's check on that question. Let's check on that particular question. Umetoka sana. Lakini niwaulize, do we normally class the normal, not this one? Is there time we normally waste? So tunasonganga the normal pace. Kuna zingine tunakanga tunalala. Watu waamke tuendelee. Tunaenda normal pace. Ngoja kwanza. Tunaenda normal pace. Na ndio uone tena nawaita hapa. You should know that there is something I know. It's dangerous for me to call this extra. Otherwise, if the normal will be sufficient, then no need. So you're asking, are we almost finishing the syllabus? The answer is no. Even if, in which case, tukicheza tu kidogo, we can even fail to finish. We may fail. Right now, if I were to rate, I will give us ourselves around 60. 60. Because we have not done, can I tell you the key topics not covered? Earnings per share. reconstruction, cash flow iko kwa group, reconstruction, employee benefits, share-based. So those are the four key topics. Those ones we have not covered, but we'll cover them, don't worry. Group tutaenda mpaka karibu date 20th next month. Hiyo tuna bio. So cash flow inafanya huko ndani ya group. So, but we will finish. So Boniface is saying 60% we are okay. We can start revision. Let's read this particular question. Tandaza Limited is a what? Fine. Whose equity shares are quoted on the Nairobi National Securities Exchange. The group manufactures, distributes, and retails food products. The group also operates a hotel chain for purposes of diversifying its revenue. The group's financial controller wishes to know if IFRS 8 operating segments applies to the entities, and if so, what segment should be reported on? What segment should be reported on? He informs you that the operating results of each of the divisions presented below are internally reported separately to the chief operating decision maker. The following information is available. So he wants to know whether they are supposed to prepare segmental reports. Number one, yes, it's compulsory. Any entity listed in the stock market, you have to prepare a segmental report. It's a requirement, it's compulsory. The following information is available. So the business which they have manufacturing, distribution, retail, and they have hotel chain. So revenue, external, so external are from third parties. Revenue internal is what you, let's say intergroup sales. So here it is segmental sales, what they sell to other segments. So you find manufacturing selling to distribution. What wamefanya MA wanaita transfer what? Pricing. Profit or loss, then we have the assets. Required, by applying the requirements of IFRS 8 to the above information, explain which of the above business of Tandaza Limited are reportable segments. 10 marks. So what are we going to check to know whether we are supposed to report on them? The 10% threshold, yes. So you check the 10% threshold. Let's start with number one. So number one, we start with revenue. So revenue you combine both external and internal. You combine them. So number one, let's start with revenue. So revenue, you combine both internal and external. Thomas is saying, let's run faster with syllabus. No, we are good. You don't worry. What you do for me, it's only one thing. Make sure uko na mimi hapa na hapa. Kama unaanza kusoma, that is criminal offense. Financial, criminal offense punishable by. So make sure we kazi yako ni kusoma. Syllabus kamaliza, that one I know. I have a good projection. So you just read every day. Make sure uko na mimi hapa na hapa. Si sasa hivi nikuuliza IFRS 13 fair value measurement. Ilifunzwa. Not here. Ilifunzwa hapa. Najua hata sasa hivi kuna watu wameshtuka hiyo. Fair value measurement. So make sure wewe umesoma kila kitu, everything. Tukue hapa. To be okay. So we can write here business. You know, at this stage, let me put it very correct by the way. At this stage, you're not supposed to fail exam. That is the truth. Because this is not the start. Unajua kama the section 1, sasa sijui who is who. But here you've been passing before. So it means either some factors, either usomi, ama kazi imekushika, which is normal, ama you are sick. Those are the factors. But you given all Yes, yes. Without those bad factors, you are a passing material. So just try to, kama usomi juu watch mpira, wachana mpira. So kuna mtu akishika kitabu anasoma na lala, lakini akiwatch Man U ako sawa. That one you require prayers. Kama ni sawa, you are a passing material because you have been passing before. So that one in your it's not the start. Even Castet knows you promote to hapa. They know you are supposed to pass. Lakini itakuwa na prayers ya kuombea watu wako hapa na ni wazazi. Now that is the most difficult part. That one, you people are really trying, and you need, first you need an award. It is not easy. Most of all ladies, men, they don't even realize. So we are not talking about men. Ladies who are mothers. Because tunasoma, unasikia umepigiwa simu, mtoto asikii vizuri. Yeah. So if you are a mother and you have been passing before, congratulations. Men, we can congratulate ourselves with what? You are reading and you have been paying rent. Alright, so revenue, you can write here total revenue. Shillings are in millions. Shillings are in millions. Alright, so combine for me, like manufacturing, combine the external and the internal. This is 460 plus 250. This is 5. This 5. Yeah, 5 plus 42, 750 plus 15, 150 plus 3. I have that. So give me the total revenue. Then you will give me here the percentages. Because I want to detect the 10% threshold. Mary, give me the total revenue. So your story, Meisha. Wake up, then look at the total. Sorry for that. Just a minute. Just a minute. So thank you. We were sorting out something. This one is how much? 710. 765. Total. I express as a percentage of the total. So this divided by this. Let's bring those percentages. So I can see answers. Boniface amenipea zote 42. 42.3. 42. Come on, we'll make a point at least. 42. I also developed a spirit of having two decimal places. 42.39%. 2.8. 45. 6, 7. 9 point. Good. So for revenue, unajionea hapo wewe mwenyewe. Unajionea. So you write there and say, under this condition, under this condition, comma, we are going to report on which ones? Manufacturing and retailing. Yes, manufacturing and retailing are considered. Manufacturing and retailing are considered to be reportable segments. Are considered to be reportable segments. Reportable segments. So that is for revenue. Let's go to profits. Let's go to profits. So I want to delete this because I just want to remain with this one only. But really are bigger. So for profits, so Roman 2, profits, stop loss, where they put it in bracket. So total profits, stop loss. Total profit, stop loss. Hey, mkiandika, listen to this. Between retailing and hotel chain, skip one line. So I'm also doing the same. Skip one line, I'll tell you why. Hotel chain, you skip one line. After retail, skip one line, then you write hotel chain. You know there? So total profits, we have 32, we have 3, we have 75. Unaona hiyo loss. So hotel chain upon a loss. Loss of how much? 14, eh? Kama ni loss, waweke na watu wao wengine kwenye wanatengeneza. But you know some people will come and say for the net off. Hapana. The ones making profit, categorize them together. Even the one making loss should be reported on. If they are making loss more than 10%, it is significant to be checked into. So the loss does not mean hiyo tunaacha. Hapana. It is making loss to what percentage? If they are making a loss of more than 10, we need to bring it to the attention of the shareholders. So loss, those with the loss, we treat them separately. So these ones are the ones which are in profit making. Add this. So don't less the loss from the profit. That is wrong. How much? 110. Then hotel chain made a loss on its own of 14. So if there were others, well and good. So for the ones in profit, get their percentage as a fraction of 110. The ones in profit, deal with them separately. So 32 over this over this, that over that. Then for the loss is 14, which is a loan. So this is 100%. That one must be brought to the attention of shareholders. It is making serious loss there. So what percentages do you get? 29.09. 29.09. 73. 0.18. I hope that is 100. So you say under this condition, manufacturing, retailing, and hotel chains. Manufacturing, retailing, and hotel chains are considered to be reportable segments. Reportable segments. Full stop. Okay, munifanyie assets. Do for me assets using the same. Do for me assets and tell me which ones we are reporting upon. Then we do a conclusion, wind up that. Work out the assets. So much you are asking the marks and we are not even done. 10 marks, everything is 10 marks. Everything is 10 marks. So they can be allocated. So Felix is saying the first one to be 66.67. Sure. Then 11.49. Then 17.24. Then 4.57. So you say under this condition, we are reporting on which one? We are reporting on manufacturing. I hope you're writing. Under this condition, manufacturing, retailing, and distribution are considered to be reportable segments. Manufacturing, retailing, and distribution. Then now, let us give them conclusion. Let's give them conclusion there. Can someone combine the workings on the table? Which workings? Felix, there are no workings. What workings for the percentages? Amma? Felix, which workings? Because I don't see any working here. For the percentages, what are they working? Some percentage surely ni kitu ya kuweka hapo kwa table. No. Guys are no. This is accounting. Don't come on FM it just show those workings. This one no. And you're trying to show examiner how have I got 29? But don't show those ones. There is no need. There is no need. In fact, your presentation should be as clean as this one. So conclusion. So Felix, I hope that's okay. Conclusion, I want us to check. Can you check how many business did you have? 1, 2, 3, 4. Oh, all the conditions. All the conditions you Felix he means for revenue, stock P&L, and assets. Or if you can combine them in the same table, if you can come up with a good format. If you can come up with a good format, he's saying that we combine all there are how many? 3. 3. If you can do the 3 in the same table. The same table meaning business. Then average total profit na percentage yake, alafu another column uweke revenue percentage ukate hivyo sawa, if it will work for you. Umeelewa kitu nasema? Yes. Sawa, if that one can make you happy, then the condition unaandika chini ya kila moja, si ndio? Unakuja unaandika condition hapo. So hiyo condition ni sawa, it's still okay. And that one will confuse everyone. Well, Boniface, come on, everyone except Felix. You will not be confused. is the originator of that. So conclusion, there were 4. There were 4 businesses. Is there any which has not been identified in any of the 3? Is there any which never qualified in any of them? All of them must have qualified at one point. So provided it is qualifying in one, then it is reportable. So conclusion, you say, under the entity should consider all the 4 segments, as reportable segments. All the 4 segments as reportable segments, under IFRS 8. Under IFRS 8. Under IFRS 8. Full stop. So all of them have qualified. All of them. Provided it qualifies in one, you need to bring that to their attention. Down there, format of a segmental report. So you have identified the ones to report on, but that question is there. So how do you present it? So give me the format. So right there, format of a segmental report. 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 You have your ruler there. So segmental reports, right? You can give it. Which name do you want? What do you want to yeah, guess what? XYZ. XYZ limited. No, not they are XYZ group. Mostly they are a group of companies. Segmental report. Segmental report for the year ended. For the year ended, whichever. For the year ended, that one there. So if you want the segmental reports, this is what you do. Let me assume that this company, this XYZ group, they only have 2 segments. Let me assume they only have 2 segments. So I will talk of segment 1, but in the question they will give you the name of the segment, like here manufacturing, distribution, and da. So I'll say segment 1. Then I will capture segment 2. I will capture here you say adjustment. This one stands for adjustment. You can write in full if you forget. Then after adjustment, we talk of consolidated. Consolidated, like that. That is enough for us. So shillings, of course. So have that. So you start with revenue. So revenue. Revenue, they can even call it sales, whichever name they call it. So you talk of external revenue. External revenue. So external revenue, in some questions, they will call it sales to third parties. Sales to third parties. So sales to third parties is the external revenue. There is nothing to be adjusted. So the total is the consolidated. Then internal revenue. Internal revenue. So internal revenue is what they sold between themselves. So in consolidation, you remember and you know. You don't even remember, you know that intercompany sales is eliminated. When we are doing consolidation, do we take the intergroup sales, the consolidation revenue? So the intercompany sales, whatever they sell among themselves, you add, then you eliminate it here. But you need to show the users that this is what we sold internally. But you eliminate, you don't take it to the consolidated. Then we may have unallocated and allocated sales or unallocated revenue, whichever. So unallocated means it is revenue which does not relate to any segment in particular. So you take them to consolidated. You just capture them in consolidated. Just relax. That all will be well. So total what you get here is called total revenue. So that is the total. Please capture that format the way I'm doing it. Total revenue like that. And then you bring here profits. You bring profits. So you start with operating profits. Operating profits. So operating profits. Then inter-segment profits. Inter-segment profits. The profits which came internally. In most questions, utapata inakuanga tu one figure. If that's the case, then fine. Just eliminate it. Like that. Then you close. You bring this one there. Then you say other items. Other items. Other items. Other items. Other items. We can have interest income. Interest income. Those interest income, you find it relates to the entire company. So we take them there. Then interest expenses. And any other unallocated item. So what you get is called profit before tax. What you get there is called profit before tax. Profit before tax. Shareholders want to know whether they will pay tax or they will not pay. So that is the ultimate goal there. Then segment assets. Segment assets. So segment assets, you go for identifiable assets. So identifiable assets. Identifiable are those which can be identified with segment in particular. Then unallocated. Unallocated assets. Unallocated assets are those which do not relate to any segment in particular. Then close. Close it at that stage. You get the total assets. So we continue the other side. So online, so we connect the Zurich and the case here. So segment liabilities. Segment liabilities. Identifiable. You proceed down there. Identifiable liabilities. So I'm assuming segment 1, segment 2, adjusted nothing. Then you go to consolidation. Then unallocated liabilities. Yes, Ali. How are you? You're very innocent. Better late than never, still. Maybe it's just about to someone that would need your side. After moving on. I like or not. So this one there, then you get your total liabilities. Then non-cash expenses. And also you have to disclose things like depreciation, amortization, impairment, stock impairment, then you get those totals down there. Many thanks there. That is the format of a segmental report in case it is required. That is the format of a segmental report. I don't want to do a huge question for segmental report. There's something small I want us to write. Then in our next class, I think we are finishing. Yeah? In our next class, we'll do computations. So, yes, so check for me. I hope you are done. Okay, you can be done. I want you to check for me something small here. In December 2017, I don't know which page is that. So that one will be our first question. December 2017, check for me question 5B. In my page is around page 90, 89, 90 there. Question 5B. December 2017, question 5B. Write it because it has computation. I want us to answer the theory part. Then we'll connect with computation in our next class. People are tired. Kama kuna nguvu ya computation. So, I'm going to find your computation more. So, it says part B, Roman 1. I hope everyone is there, page 89 or thereabout. December 2017, question 5B. Roman 1, page 89. It says, with reference to the International Financial Reporting Standards IFRS number 8 operating segments, outline 4 disclosure requirements for reportable segments. So what do you need to tell us when you are giving a segmental report? So when you are required to give the disclosure requirements, you're easy up. Just master the format. You need to tell us what? Revenue, these are the disclosures. Revenue, profit or loss, segmental assets, segment liabilities, and non-cash what? Expenditure. But let's write them in a good manner. So right there, disclosure requirements under IFRS 8. Disclosure requirements under IFRS 8. So number 1, general information. Number 1, you say general information on how the entity identified. General information on how the entity identified its reportable segments. That is 1. So what is that information? How do they identify their reportable segments? By applying the 10% threshold. So the 10% threshold on what? Revenue, profit, and assets. That is how they identify. So you need to tell us that the reportable segments were identified by applying the 10% threshold on the entity's revenue, profit or loss, and assets. Number 2, information about segment profit stop loss. Information about segment profit stop loss. So here. 2, information about segment revenue. Information about segment revenue. Information about segment revenue. Both external and internal. Both external and internal revenue. Both external and internal revenue. Next, information about segment assets and liabilities. Information about segment assets and liabilities. Next, information about non-cash expenses. And capital expenditure. And finally, a reconciliation statement. For revenue. Comma, assets and liabilities. Full stop. Can we do the computation in part B? It's all about you. Are you okay we do that computation? Majority will take the day. So if you keep quiet, Me as the chairman. We do it next time. People are, but we have tried from 7:30. So no. Those who came late, someone is to share the notes online, then it will be okay. So thank you. Let's meet tomorrow for evening. This evening we have a class tomorrow. Yes, let's meet tomorrow. Another classes we meet in our respective classes for group accounts. I thank you. You can leave.